I am going to call my panel up now. Firstly, while they're coming up, I will introduce them. I've got David Damiba, the managing partner and co-CEO for Kasada Capital. I've got Folaseto joining us from Actis. It's great to have you both join me. Unfortunately, Marc Wachsberger isn't able to join us, so it will just be the two of us and myself. And looking forward to a good conversation with two of the most active investors in hospitality in Africa over the last few years. So good. I think I'll start by just asking the same question to both of you. If you sort of look back on the last 12 months and I guess update the room of what you've been up to and how that sort of links into your portfolio that you've built to this stage and your evolution and story on the African continent. So Folaseto, let's maybe start with yourself.
Okay, thank you, Wayne. Over the past few years, we've really been investing in hotels. We have a partnership with the Westmont Group. They were mentioned earlier. And what we've done is we've acquired 7 hotels across the continent in 4 countries, in Nigeria, in Morocco, in Kenya, and in Tanzania. So as part of that, we've implemented some CapEx programs across different assets, and we've been primarily focused on value creation across those assets. So that's what we've really been up to.
Good. David?
Thanks, Wayne. For us, the last 12 months has really been about consolidation. So we spent 3 years before that acquiring a portfolio of about 20 hotels across Africa, and we're the most active institutional investor on the continent. But the last 12 months has really been around consolidate these assets, mainly brownfields, invest capital expenditures in it. We're probably running one of the most complex CapEx program across multi-jurisdictions in Africa in this sector. So that's really kind of the focus now around CapEx and value creation.
I'm going to follow on from that because we absolutely heard around the challenges around some of those areas around construction costs, but also the high cost of capital. I mean, how are you, I guess, tackling these headwinds and how have these been affecting you in an African context?
Yeah, it's I think probably worth looking backwards a little bit. The sector in itself in Africa, historically going back, let's say 20 years, has had a major issue around financing and around cap structures, right? So inefficient financing, the lack of bespoke debt programs that would enable a hotel to ramp up and be able to meet its debt requirements, and the scarcity of equity across the continent. So that's historical. But then there was a positive, which was yield curves that collapsed since the financial crisis, and you had in the West quite low interest rates, which was advantageous. And in some ways, a lot of African countries benefited from those low interest rate environment and issued a lot of Euro bonds, so created a relatively decent macro environment to borrow at least in local currency. But all that got turned on its head post-COVID, where the yield curve turned around. So it made the historical issues that existed in Africa actually much worse, right? So in order to put a cap structure together with the right amount of equity and decent amount of debt, everything is upside down. And on top of that, with the rise of inflation, CapEx programs and construction costs, renovations will get more expensive. So the way we look at it and the way we position ourselves is facing these headwinds as we're focused investors in this sector. We're long the long view of this sector for us is bullish and positive, but it's really a focus on risk management at that point, right? So how do you create a capital structure that can withstand more risk in an environment that's difficult, and how do you deal with it? And which is effectively dialing down the debt levels in some ways, dialing down the debt levels, underwriting to lower numbers. Also assuming, understanding, as you show, that you're looking at yield curves that are going to be regressing down the road. So it's really been around managing the risk, lowering the leverage, and in some ways you have to be a price taker if there's a bit of inflation. And also sometimes resizing CapEx programs so that you don't have to go full in, you can go 25% in and potentially do the rest once you have more visibility and control risk better.
Got it. Okay. Folaseto, I guess maybe a good place to also start is even to take a step back from hospitality, because ultimately we're talking about real estate as an asset class, and a lot of liquidity and the African investment story is a real estate one. As investors that are not only exposed to hospitality, why don't you sort of give us, how are you seeing these same headwinds, these same environment sort of issues for the non-hospitality sector?
Okay. So looking at the different subsegments of the hospitality sector, I think one key shift that's happened is just COVID. As a result of COVID, we've seen different behaviors across the different subsectors in real estate. In the office space, obviously because of COVID, you have a lot of people working from home more now. Hospitality was largely affected as a result of COVID because there was limited travel across board. On the retail side, that was also impacted. But on the positive side, what we saw was there was now a significant demand in other sectors, such as the logistics and warehousing sector. As a result of COVID, that sector picked up quite significantly. We're active investors in the data center subsector. And what we saw was that sector also increased significantly in terms of demand because everyone migrated to online, working from home, the internet demand, the explosion in demand for internet demand. And what we are seeing is globally, the demand for data centers is expected to grow by 3 times by 2030. So that's quite significant growth. We've also seen increasing investments in subsectors such as private healthcare facilities, in educational institutions as well. And retail, continues to be the holy grail. Residential continues to be the holy grail. People, they need to live. But we've seen pressure on the residential market as a result of inflation, which is a global problem. Overall, we think that the real estate sector across board continues to be quite attractive due to very strong secular trends, such as increasing population, urbanization, and we believe that real estate continues to remain, a big store of value, which is what investors look for when they invest in real estate.
Got it. All right, and David, it was a question for Marc around some of the sort of recent changes in South Africa from a political point of view, but yourselves having been very active and particularly in Cape Town recently, how do you see some of these changes at a macro level and just, I guess, from a broader Southern Africa context where you've obviously got exposure, how do you sort of see these potentially supporting and going forward?
Yeah, so I think there's been obviously quite a lot in the news around political movements and changes or adjustments in South Africa. So I have a view of the world where there's the news and there's the analysis of macro events, and then there's what is actually financial markets pricing in, right? So, which is always kind of how I grew up to understand risk. So the reality of it is that whatever's happening on a political level in South Africa, from a financial markets perspective, in terms of the pricing of risk of South Africa, it's actually improved, right? So on the current basis and on a forward basis, the South African rand has actually behaved pretty well. Is it overly pricing positive events in the future? Potentially. Is it worth being potentially buying protection? That could be one aspect of it. But if you just take a high level view, based on what has happened, there hasn't been anything that will create a major disequilibrium within the ecosystem. So that's point one. So we're fine with that. And in terms of economic growth in South Africa, it's been relatively tepid the past few years, and on the forward basis, not necessarily in top decile in Africa, and it's probably going to remain the same. But we assume base case stability. But as investors in hospitality, within that context, we see a little bit of 2 different worlds, right? So you have a Cape Town where we've invested quite a lot of capital, and you obviously have obviously it's a big country, but for us we really focus on 2 cities, Johannesburg and Cape Town, in terms of looking at it. We haven't invested in Joburg yet. There's some potentially interesting opportunities there, but we've invested in Cape Town as it's It's a play that is not just a local play or a regional play. It's the ability to invest in that country and in a town, but you also get international kind of risk, right? So there is a bit of a de-risking effect from taking. If you were to do the analysis, you're probably not taking full macro risk on South Africa, but you're taking a little bit more. You're globalizing your risk a bit. And in terms of pricing and the dollarization of that hospitality sector. In that country, in that city, there's just a higher correlation to the dollar, especially as you move up the segment. So our approach to Cape Town has been commit capital there from a risk-adjusted basis, looks quite attractive, and then segment your capital that you deploy in that sector. And we present at the luxury segment with our Fairmont Cape Grace. We're entering the lifestyle segment with our Mama Shelter that's in construction, and we also have a business hotel with a Pullman. So we're positioning ourselves from a risk perspective in the way we look at it. And if you want to look at it on a broader basis of Southern Africa, as I said, we don't think anything in SA that just happened is disruptive. We're excited and confident about our investment in this wonderful town of Windhoek, and we're looking forward to it to grow over the years. So we're fairly positive and nothing too aggressive. But it's really, at the end of the day, it's understanding the macro, but also how do you position your risk capital in order to kind of nullify a little bit whatever risk there is.
Absolutely. And I think that macro story can mean different things, right? I mean, and you touched on, currency and depreciation also means more affordability from an international perspective. And there's a sort of natural hedge when you can sort of price in dollars from that point of view. And that's really what's driving a lot of the local currency rate growth that we saw earlier. Folaseto, you touched on your approach and strategy, and obviously partnerships has been quite a big part of that. For large private equity player like yourself, how did you see that and embark on that as sort of central to your strategy?
Okay. So just speaking on partnerships, I think partnerships can be beneficial. In our case, we partnered with Westmont Group. They have significant experience in the global hospitality space in managing hospitality assets. So from that point of view, there was shared expertise. We're able to leverage on their expertise in the hospitality management space. The other benefit from the partnership was just an enhanced capital pool. So what that meant was, you have two pools of capital, which means you have a much larger pot to invest from. The other thing was risk mitigation. We were not going in on our own. We had a partner that could help us, hedge some of the risk we could potentially face. And then by leveraging the fact that they're a global hospitality hotel operator, we're able to leverage their global expertise, which they were able to bring into the African continent and just, try to implement best practices from their global partnerships into our hotels.
Yeah.
And then, joint decision making, we're able to come together and make decisions together. And so it's been a very positive partnership. I think one thing I would advise, or just things to bear in mind when looking at partnerships, is just, it's very important, and this is with every kind of partnership in life, with personal partnerships, business partnerships. It's very important that there's an alignment of goals. You both need to be aligned with your goals and your vision. Also, in terms of agreements, there needs to be clear legal agreements that guide the partnership. You need to think about things like responsibilities and roles, profit sharing, what are the rights and protections of each partner. And then, if in our case, we are a private equity investor, so we have a limited time period for investments. So thinking through things like exit strategies and, how is that aligned with what our partners are trying to achieve. And then, just thinking about people that may be looking for capital partners like ourselves, just some things to bear in mind is just, showcasing your track record, showcasing your team, the strength of your team, your experience, and also, you have to be able to showcase having some skin in the game as well.
Absolutely. I mean, David, anything to add there on partnerships? And I mean, I guess obviously it's a similar story for you to date.
Well, yeah, we're set up a slightly differently than our peers at Actis. Our approach to the sector was to kind of create a platform that effectively regroups both the Westmont side and the Actis side, if I may. But yeah, partnerships are key across the continent. There are situations where we're very open to co-investing. I think it's a sector that is so capital intensive that requires so much over the coming years that I hope we're going to see a lot more partnership within even co-investors between firms themselves, and also partnership with local investors or local banks or local institutions, and in some even cases where we're looking at where we can partner with an actual government who can commit capital to a strategy and invest as well.
Well, I think if I may, comment on both of you, it's, at this formative stage, it's really about creating those blueprints and those success stories, successful deployment, successful returns, asset management, the stories, and there need to be sort of versions of each other and a bit different to kind of give, the big investors and those looking to come in a blueprint for what works and how to sort of approach the sector. So that's really key now. I mean, I think the hospitality sector in terms of creating platforms is leading. Even some of the other real estate asset classes can learn a lot from some of the platforms being created in hospitality, and that's really, I think, important to really driving big institutional liquidity into the continent. But David, maybe just to sort of follow on in terms of your portfolio today, and you touched on that sort of getting access to sort of other segmentation on the leisure side. I mean, do you see that, in an opportunity through other urban markets in Africa to tap into it, or is, I guess, Cape Town sort of more of a exception to the rule?
In terms of the leisure segment,
yeah.
So the core of our strategy has been kind of the business hotel in major cities across the continent. But as we evolve and we develop more and more understanding of the certain dynamics and also see the asset class move a bit, we are definitely taking more and more interest on the leisure side of the equation that is on the continent. We did an acquisition in Senegal on a hotel that's effectively we turned into an Olympic resort that's doing very well. There's leisure not only brings a certain diversification to a platform and to a portfolio that is not necessarily highly correlated to the typical business hotel. But especially as you move up the segments, you got different business models, whether it could be all-inclusive that have a very, very, very different risk profile that could be really attractive from how low the volatility of those returns are. That's one. And then two, we're developing the belief that in some cases on the high-end space, especially, some leisure assets that are linked to Africa will potentially be recipient of very high valuation and be attractive to international global investors, right? So a global investor sitting in the US might be less keen to just purchase a group of a hotel in central cities in Africa, but might resonate a little bit more to a large resort that is on whether in Indian Ocean or anywhere in Africa or a new destination that you'll find in Africa. So we're spending quite a bit of time there, and hopefully we'll do some acquisition or develop some new projects on that.
Yeah, and that's something you've both sort of said around how important that strategy and thinking towards exit is. It's obviously pretty core. All right, I think it's probably the sort of last question for both of you, and a really important one around ESG and I guess the opportunity for Africa. I mean, we've seen all the metrics and all the numbers still very low. But is ESG an area that Africa can really sort of appeal to global sustainable linked capital? And what are some of the things that are working well and barriers that need to come down to be able to access that a little more efficiently? So, Folaseto, I'll start with you.
Okay. I think, globally, ESG has become critical. Whether in the African continent or across the globe, it's become very critical, especially in the hospitality space, just given where hospitality sits in terms of global emissions. So I think that it's, very critical for ESG to be incorporated into our investments. One of our hotels recently was Advanced Edge certified. So that's something we're really proud about. And ESG is something we're very conscious about. But I think also for the African continent, in terms of getting ahead of ESG and being able to access pools of capital that are available for ESG compliant investments, such as green bonds, being able to access DFI capital. I think being very conscious and incorporating ESG into your investments is very critical for the future.
Okay. David?
Yeah, for us, it's embedded. It's definitely embedded within our DNA, and also our strategic partner, Accor, brings a lot to the table from the operator standpoint on that. I think it's a key thing, and I think beyond even hospitality, relevance in real estate going forward will only exist with the right ESG strategies around the buildings, et cetera. Otherwise, it's actually something that's modelable in the sense that you'll get to zero value on your real estate if you're not compliant down the road, and it's happening in Europe and in the US. So that's key. But the fact that we also operate in a continent in development, we can really do a lot in our ability to actually impact our communities, and that's where we spend a lot of time, and we invest quite a lot, and we're very passionate about and making that impact. And because we've been fortunate enough to have quite a bit of capital in our platform, we're really working on driving a lot of these initiatives across the continent, and me personally, that's kind of honestly one of the joys to bring in beyond the environmental and governance. It's really the social bit as well, which is huge.
And on the sort of capital side, I mean, do you see it as more of a sort of metric to unlock new pockets of capital, not necessarily accretive at the moment, but where do you sort of stand on that?
On the capital side, I think it's fundamental. I think it'll attract more equity, right? You'll attract more equity with that. And on the financing side, it's going to be huge. I think mentioning what she said around green bonds, I think financing has been an issue for all of us in hospitality, and we're trying to make a difference as larger platforms. But green bonds and things related to that type of financing are going to be game changers. And I think as institutional investors, we can actually probably be at the beginning of the creation of a market of the green bonds financing real estate across Africa.
Great, and probably something for the investor console that Olivia was talking about earlier. Absolutely. Good. Well, that's us coming to an end of this session. It's been great to have two colleagues and friends on stage. I think obviously a lot will still come out through the rest of today, but feel free to grab us at any time through the conference and get our views, and really appreciate you two joining us today. Thank you.
Thank you, Wayne.